Accounting principles refer to the fundamental guidelines and rules that govern how financial transactions and reports are recorded, processed, and presented in accounting. These principles ensure consistency, transparency, and accuracy in financial reporting across different businesses and industries. Here are the key accounting principles: accrual, principal efficiency. Revenues and expenses should be recognized when they are earned or incurred, not when cash is exchanged. Example, if a company provides services in December but receives payment in January, the revenue is recorded in December. Consistency principle definition. Once a business adopts an accounting method, it should continue using the same method in future periods, unless a change is justified and disclosed. Example, if a company uses the straight line method of depreciation, it should continue using it in future periods, unless there's a valid reason to switch. Going concern principle definition assumes that a business will continue to operate for the foreseeable future, and its financial statements are prepared with this in mind. Example, when preparing financial statements, the company assumes it will not be liquidated or forced to close in the near future. Matching principle definition. Expenses should be matched with the revenues they help generate within the same period. Example, if a company earns revenue in January by selling goods, the expenses related to producing or delivering those goods should also be recorded in January. Conservatism principle definition. When choosing between different accounting methods, accountants should choose the one that results in lower net income and assets, providing a more cautious approach. Example, if a company faces uncertainty regarding an asset's value, it should use the lower of cost or market value to record the asset. Economic entity principle efficient. A business as financial transactions should be kept separate from the personal financial transactions of its owners or other businesses. Example, if the owner of a small business buys a car for personal use, this transaction should not appear in the company's financial statements. Full disclosure principle efficient. All relevant financial information must be disclosed in the financial statements to give a complete and accurate picture of the company. Financial health. Example, if there are legal proceedings that may impact the company's financial status, they must be disclosed in the notes to the financial statements. Monetary unit principle efficient. Only transactions that can be measured in monetary terms should be recorded. This principle assumes a stable currency without accounting for inflation or deflation. Example, a company's employee morale or customer satisfaction, which can't be directly quantified in monetary terms, is not included in the financial record. Periodicity principle. The life of a business should be divided into periods for the purpose of reporting financial performance. Example, a company prepares and reports its financial statements on a quarterly or annual basis. Revenue recognition principle efficient. Revenue should be recognized when it is earned, not necessarily when cash is received. This aligns with the accrual principle. Example, a company that delivers goods in March but receives payment in April would recognize the revenue in March when the goods were delivered. These principles are foundational for creating financial statements that are accurate, comparable, and understandable to all users, including investors, creditors, and management.